The US dollar index is testing 13-month highs and the potential steep breakout above the 101 resistance, supported by expectations for a higher for longer interest rate environment. Front-end yields are leading the move, with US 2-year yields testing fresh 2026 highs, while the 10 and the 30-year continue to lag. And this divergence is building conviction for short-term US dollar dominance against the markets, while the long-term trend remains unconfirmed. Hello everyone, this is Razan Hilal, market analyst with Forex.com, live from Dubai. Today is June 22nd, 2026. So while the US dollar index attempts to hold price action above the 100.80 mark, which was a previous support to price action since 2022 and recently turned into a resistance, a multi-year barrier that can potentially open the path for a steep bullish breakout on the US dollar index that may pressure markets further into deeper drawdowns, including currencies and precious metals. Now, with respect to the US bond yields, we can see that the US 2-year yield is pointing to fresh or trending at fresh 2026 highs above the 4.2%, while the 5-year yields remain muted within a consolidation pattern slightly below the yearly highs. And the further we go in time, the 10 and the 30-year yields are still lagging fairly below their 2026 highs, pointing towards additional confirmation for a long-term bullish breakout in the US dollar index, taking levels step by step as we move forward with the charts and with the ongoing developments between the US and Iran, the closure of the Strait of Hormuz, and the upcoming inflation figures. So as the old saying goes, the trend is your friend, and the DXY has been respecting an uptrending framework, an uptrending parallel channel since the lows of 2008, and that overall bullish bias has been also respected at least since the lows of 2025, that also realigned with the bottom bound of that uptrending channel. Now, currently price action is testing a critical multi-year barrier that I previously mentioned, which connects was a previous support to price action since 2022 and recently turned into a resistance in 2025, which is a multi-year barrier that may open the path for a steep bullish breakout on the US dollar index should we have that confirmation above the 101.10 to the 101.20 mark. Now, if we take it from a Fibonacci retracement perspective of the overall trend between the highs of 2025 and the lows of 2026, we can see the price action is currently aligned with the 38.2% Fibonacci retracement, and a sustained hold above this level would likely open the path for another rally towards the 102.80, which aligns with the 50%, and the golden 618, which is 104.50 mark, and the potential target for a double bottom formation that is likely in the process for a potential breakout. Over here, should we have that sustained hold above the 101 to the 101.20 mark, looking at daily to weekly closes to avoid any bull or bear traps with the potential extended volatility on the charts regarding the ongoing negotiations between the US and Iran, and the potential closure of the Strait of Hormuz, which may also weigh further on inflation reports and build further conviction and expectations for extended rate hikes towards year end. Now, on the downside, we have notable uptrending supports that have been connecting or that have been sustaining the bullish bias for the US dollar index across 2026 and against the markets that can be seen on the weekly time frame over here, with price action respecting an uptrending support connecting consecutive higher lows since the lows of 2026, alongside another uptrending support also connecting consecutive higher lows since May 2026. And a confirmed breakdown below these uptrending and multi-month supports would likely shift the overall outlook and sentiment towards bearish on the US dollar index level by level. So over here, we'd be looking at a confirmed breakdown below the 99.30, and further down, we'll be looking at another breakdown below the 97.60 to potentially start building a bearish forecasts once again on the DXY, and of course ultimately the longer term level that needs to have a sustained breakdown to be able to confirm the overall long-term shift in the US dollar index positioning would be the 95 mark, lining with the bottom bound of that uptrending parallel channel since the lows of 2008. Now, with respect to momentum, if you look at the monthly RSI, we can also see the indicator pointing towards the upside and above the 50 neutral mark, which is also building the case for at least short-term bullish positioning on the US dollar index. that may eventually find potential resistance or pullback risks over here that may determine either a continuation towards the mid zone of that uptrending channel, extending the overall bullish bias on the DXY since 2008, or potentially represent the markets and the DXY with another rebound risk, potentially targeting the bottom bound of that uptrending channel once again before confirming any long-term bearish shift on the chart. Beyond the mentioned key technical levels and price action positioning across the US dollar index chart, the US 10-year curve remains a key factor to watch, as a continued rise in longer-term yields may reinforce the bullish outlook on the US dollar index, particularly if upcoming US economic indicators reflect ongoing inflationary and growth implications as a result of the disruptions across the Strait of Hormuz.